Hello, class. Say, wanted to put together a little bit of a video, and I apologize for the length of it, but some of you may not be quite aware of some of the things that you can do as far as the adjustments. And when we talk about an accrual double entry accounting system, this is kind of the nuts and bolts of it, and it's going to give you the ability to actually accurately show your net income, profitability, and true balance sheets and things like that. So it's kind of important. Chapter 5, you have to go through it fairly slowly if you're not really much of an accountant. And I'm there with you. I'm not an accountant. I've been doing my own books for my own businesses for the last 35 or 40 years, but it still takes a little bit of fortitude and discipline and pragmatism in order to do this kind of thing. So anyway, I encourage you to do it. You're going to get a better product on the other end to make great management decisions with, and we'll get on with it. There's some transactions we want to use, go into the test drive, and we'll show you how you're going to go through that, and then you can work through it using your Beach Barkers example through your own QuickBooks. Okay, so first of all, and this is something that I actually have posted on my wall here in the office, and it's just really important. I know that we covered it earlier on in the semester, but if you're not an accountant, it's probably not ingrained in your being. So you can have a cheat sheet. There's nothing wrong with that, especially at this level. So and I've got it hanging on the wall here, and I refer to it because I refuse to memorize this kind of stuff. So I'll be referring to this little diagram so that that we can make the correct entries. And that's what this chapter 5, is: ending period or adjusting factors that we are adjusting entries that we'd make throughout the year. Okay, so let's go ahead and visit about them. The first one that we want to actually oh, I didn't want to do that, but here, maybe it'll go back before. Okay, there we go. We're in Craig's design, and the first thing that we want to do is handle our prepaid expenses at the end of the current period. Now, in this particular example, we're going to do it every month for our prepaid expenses, and in this example, it's the prepaid insurance. Prepaid insurance is an asset account. We pay ahead of time. We have to pay for that, and that's very normal with insurance. We in the Beach Barkers example, we had some insurance we prepaid. We also had some cleaning supplies and office supplies and so forth that we put in that category of prepaid expenses, and it is a current asset. Okay, so on the books it would show it as a current asset. First of all, in order to make this, we're going to have to make a journal entry. We're going to come up to the plus key, and if I can, there it is right there, journal entry, and make sure dates are really important. Everybody I talk to in the in-class portion, I remind them of that on a daily basis, but this is my chance if you're online. So in this case, we're going to enter these as the end of January. So very, very important. This is really a simple entry. We're actually going to increase an expense account called insurance expense. Okay, so we're just going to type in there, should have an account in there for insurance. And we see here, this is the big deal right here, expense account. Okay, and we're going to increase the particular insurance account or expense account by $75. Okay, all right, no money is coming in or out of the business. We're just making an adjustment within the business. So no check is written. It's just a journal entry. Okay, so we debit our insurance expense by $75. Now, with every transaction, debits must equal credits, as most of you know, but if you don't, then I'll just reinforce that. Where is that coming from, basically? If we're going to increase our insurance expense, we're going to have to credit something else, and that would be the prepaid insurance asset account. Okay, so we would have a prepaid insurance right here. We happen to have one. It all of a sudden it enters it like that, and we would say save it at that point. Okay. All that did was deduct $75 out of that asset account called prepaid insurance, and then increase the insurance expense for that period for $75. That's all it did. Let's talk about another one. Depreciation is an adjustment that we generally have to make. All it is it's just decreasing the value of a particular asset over its useful life. And in this case, we're just so that we can gain some practice, we're going to do it on a monthly basis. This is something, if we're talking about agricultural books, that we'd probably do on an annual basis. You may want to reflect this on a quarterly basis or a monthly basis, depending on what kind of business that you're running. Okay, so it's a really simple thing. No money in or out. We're just transferring or making that adjustment within the particular business that we have. Dates, okay, it's already preset. We're just following up with another adjustment in our journal, so that we don't have to change that, but something to take into consideration. We're going to increase our depreciation expense. Again, expenses, and in order to increase them, we have to debit them if you look at your T account examples. So let's see if we already have a depreciation expense. We happen to have one within our chart of accounts. It's an other expense right there. We're going to use it. We're going to debit that by $110 as it shows in the example from the book. Okay. Now, what are we going to what is going to be the other side, or the credit side of that particular transaction? In this case, the example given is the truck, okay, and we're going to actually use a sub-account, a sub-asset account called depreciation. Some of you may be familiar if you're taking accounting. This sub-account to truck is actually a contra asset account. It appears there. It's a negative. It adjusts the truck's value negatively. Okay, so that's what that means. We're going to actually use that truck depreciation account, and it's going to credit that so that we depreciate that truck. The value of that truck is going to decline by $110. If you look up and you look at your asset account, any asset account, if you credit it, it decreases that particular asset account, okay, in which we're doing here. We're going to increase the amount of expenses that we're going to show for that period by $110. All right, hopefully you're following along here. That's that kind of an adjustment. We might do that for all the assets that we have in that particular period. Okay. Now, at the end of any particular period, and we can do this on a monthly basis, again, many times we would do this on a quarterly basis, or we would do it on an annual basis, especially for an agricultural operation, depending when you really need to see these numbers as far as profitability and that sort of thing. Okay, but let's talk about, right from the book, it talks about transferring your opening balance equity accounts, okay, to a capital account. Capital accounts are ownership type accounts. Those are owner equity accounts, okay. If we go to our cheat sheet, owner equity accounts, if we debit them, that would be a decrease, okay. That's the left side of the T account. In order to increase that equity account, we'd have to credit it, the right side of that equity account. Okay, so we're going to transfer monies that have been building up in this owner's equity account to our account, our owner account. Okay, so that we can use them later. You'll know exactly what that is because we're going to talk about owner's draws here in just a few minutes. Okay, so date, pay attention to that. We're okay so far, so good. We're going to use the open balance equity. Okay, it's an equity account as well. Okay, so are we going to increase or decrease that? We're actually going to transfer it from open balance equity that QuickBooks actually builds up as we're buying and we're making sales and all that kind of stuff, and we're going to transfer it to our capital account, both of these being equity accounts. So if we debit a equity account, that's going to decrease it. In this case, the first one in the example is we're going to actually decrease it by $35,000. Okay, we're going to transfer that $35,000 to an owner equity account called Todd Jones. That's me, and that would be you in your case if you're running the business or the owner of the business, and that will be go into something that we call a capital account. So I'm going to make it so it's very obvious, is I'm going to name it Todd Jones Capital. Okay, it does not recognize that since we had not actually entered that capital account yet, or that equity account. So it's going to say, okay, what kind of account is this? Well, first of all, it is an equity account, right? And it's going to be an owner equity as the detailed type, Todd Jones equity account. Okay, we may have several people involved in the business as shareholders, as members if you're an LLC, or partners. Okay, so in this case, we didn't have any opening balance. We're just making that capital account. We're going to save and close it, and we're going to transfer that $35,000 into that capital account in this case. Okay, there you go. Now, the important things as you work through this, and what I implore you to do, is to go look at either your trial balances, would be a great report to look at as of 1/30/17, and even more so your balance sheet to see what happened to that opening balance equity and how it was posted within that particular report. Okay, so that's your assignment after we make these particular adjustments. Okay, now, and this is something that I deal with in my businesses all the time, is that we're taking actually monies out of our capital account, as we did just a minute ago, and we're going to actually pay an actual check to me and my wife so that we have money to do with what we want, our personal expenses and things like that. So, and that's called a draw. Okay, an owner's draw, or a partner's draw, or a shareholder's draw in the case of a corporate setting. Okay, so that one's accomplished fairly well. That's an actual physical. We actually take monies and we're taking it out of the business. So we don't. It's not an internal entry adjustment. We actually write a check. We don't use a journal entry to accomplish that. Okay. So we're going to actually get out of journals, out of that actual journal. We're going to go and we're going to actually write a check right here. Okay. So say that that Todd and Nancy, or in this case Todd Jones, is going to take out a draw of $1,000. Here's a check we're going to write. Of course, we're going to have to put Todd as we're going to have to add him into this. We're going to say that's a vendor. Okay, we could do more. We could add an address and all that, but it's going to come out of checking right there. Okay, and what we're going to do, the amount is going to be, let's see, print check later. Okay. Now, what account are we going to use for that particular one? Actually, the account would be the Todd Jones capital account. Okay, the amount would be $1,000. Okay, in this case. And then we would save it. Okay, and the amount, it actually placed $1,000 in the amount. Okay, and if you were to look at your balance sheet, your trial balance, or any of those reports as of 1/30, if that's the date I used, and I was correct about that, then it would actually deduct $1,000 out of my checking and deduct $1,000 from my capital account that's within the company. Okay, hopefully that helps you. There could be the flip side of that, where I want to add more equity. Say that the business is cash poor, and all of a sudden the business has to come to me and actually ask me to provide cash to the business. I want to keep track of that. How do you get it in there in a proper accounting procedure? Well, that would actually be a journal entry. Okay, what we're going to do here is I'm going to get out of the checking part of it, and I'm going to go back into a journal type entry. Okay, and this is, again, okay, dates. Okay, it's staying on 1/30, so that's okay, isn't it? Okay, what I'm going to do is I'm going to actually, from the outside, I'm going to increase my capital account. Okay, but I'm going to also increase the checking account. The capital account is an equity account. If I look at my cheat sheet, if I credit the capital account for Todd Jones, then that will increase it. All right. The other account that is going to affect is going to increase my checking account. Okay, and that's an asset account, so that would be a debit. So here, let's make that entry. We're going to use the checking account. We're going to debit it by $3,000. Okay, and then we're going to use Todd Jones's capital, and that's going to be another $3,000, and we're going to save it. Okay, so I don't want to make these videos too long because I don't want to put you to sleep, but you could use these if you're having trouble getting to nodding off at night or something like that. But hopefully that helps you as a primer on how, with your own company, the example you're going through, and then my prayer actually is that you start using this type of a double entry accrual system so that you can actually see the true net income or profitability of your company and make some great decisions with it. So over and out for now. We'll put another one of these up possibly, and we'll see you on the next one.